Leticia from Biltmore Bank, I think, mentioned the business credit rating with Dun & Bradstreet. Everybody heard of Dun & Bradstreet before? Okay, how many of you have a DUNS number that you know of? Okay, most everybody, good. So if you don't have a DUNS number, you go to Dun & Bradstreet's website and apply for a DUNS number. Chances are you already have a DUNS number, even if you don't know what it is. And that basically is the way that the financial institutions can access your business credit rating. It's not your personal credit rating, not the Experian, TransUnion, and Equifax rating. This is your business rating, which is what Dun & Bradstreet does. So here are the key criteria for that: performance on past loans. Pay your bills on time. That's the key word here. Borrowing compared to income. So you don't want to get over leveraged. You don't want to borrow more than you can afford to pay back and making those monthly payments. And equity. How much is your firm actually worth? What's the equity value of your firm? And that's another key element of it. So that's how you manage that. Now, it's important for you to clean up your financial statements. Okay, and the first and most important thing about cleaning up your financial statements is what we call CICDROOM. CICDROOM. C-I-K-D-R-O-O-M. Anybody want to hazard a guess? Okay, so the first part of it is cash is king. Okay, cash is king. Cash is the fuel that makes your business run. What happens when your car runs out of fuel? It stops. What happens when your business runs out of cash? It stops. Right. So cash is king. Conserve your cash at all times. So that means managing your overhead, keeping your expenditures to a minimum, all of those sorts of things. And the second part is DROOM. Don't run out of money. Okay? Now, this is the CEO's job, is to make sure that the business doesn't run out of money. The CEO cannot delegate that job. You can't say blame it on the accountant or the treasurer or the banker. It's the CEO's job to make sure the business doesn't run out of money. And by money here, we mean not just cash, but also credit. So you got credit cards, you got all kinds of, you got loans, you got whatever it is. Don't run out of money. Because when you run out of money, you're also going to stop your business. So number one, manage your accounts payable. Pay your bills on time. You can wait until they're just about due, okay, in order to conserve cash. But when they're due, make sure you make that payment. And of course, with computers, you know, I've got all my credit cards set up so they automatically pay the minimum, at least, of what's due. I can add more to it if I want, but automatically pays the minimum on the due date so I don't miss out on any payments by mistake. Manage accounts receivable. Okay, if you've done work and they say they're going to pay you in 30 days, well, you don't count on that, right? So somewhere between 20 and 25 days, you send them an email just to remind them, hey, expecting that check coming up next week, okay? And then 2-3 days later, you can call them again and say, hey, what's your plan for getting me my money on time? So I hate to say this, but I sent a $600 bill one time to a Fortune 500 company. I'd done a little bit of work for them. $600. Fortune 500, $8 billion company, okay? So I called them up on day 30, my mistake, said, where's my payment? And the guy says, what payment? What invoice? What are you talking about? I said, well, I sent you an invoice 30 days ago. Well, I don't know where it is. I don't remember seeing it. Send it to me again. Okay, so I sent it to him again. What happens on his mind, that starts the 30 days over again, right? Now, I know that he got that invoice, okay? No question about it. I know it was on his desk. They were gaming me. A Fortune 500, $8 billion company was gaming me over $600, okay? That's how they got to be a Fortune 500 company. So you got to manage those accounts receivable. And if somebody has payment terms that are 45 days, which is not uncommon these days, maybe you want to do business with them. If it's longer than 45 days, I wouldn't do business with them. That's horrible. That's horrible. And of course, in Arizona, if you're dealing with a prime contractor and it's a pay when paid kind of a contract arrangement, remember they've got 7 days after they get paid to pay you. 7 days. And there are penalties if they don't meet that 7-day requirement. So enforce that on them. Most of the good primes are paying you in 2 or 3 days within when they get the check. But you know, some of these others may be a little shakier than that. So manage your accounts receivable. That's a way to control your cash, to keep your cash. Cash is king. Minimize your overhead. You know, you can, if you need a place to meet, a fancy office, you can get an executive suite. For $10 an hour, you can have a conference room. You don't need to have, you know, a big fancy office all the time. Think about all of those little expenses that you incur on a regular basis. Make sure, you know, you plan people's travel around town, all your people, so that they, you know, minimize the mileage expense, minimize that fuel cost. There's all kinds of things you can do to that. Allocate your direct costs to the contracts. People don't always think about all of their direct costs that they can charge against contracts instead of just you know, basic labor. You can also put all kinds of supplies and equipment and whatnot. If they're direct costs, insurance sometimes, your bond costs in particular, you can assign to a specific contract. When you're calculating your equipment rates, some people don't really think about all of the costs of the equipment. So you've got maintenance costs, you've got repair costs, you've got the cost of the equipment or the loan and principal and interest that you're paying off on that equipment. You've got the personnel to run the equipment. You've got depreciation on that equipment. Talk to the guys over there at Price Kong, the CPA firm over there. They've got that whole area nailed. They know all there is to know about it. So be real careful about making sure you put all the costs into that equipment, insurance and everything. And then manage your projects to get a faster finish. So if you look in the handbook, give you a reference to a Wikipedia article that compares all of these different project management software pieces. Find one that you like. I like Microsoft Project because it's easy and it's dumb and it's cheap and it's part of the Microsoft family and it's what I do, and so I use that. But I'm not saying you have to use that one, but there are a whole lot of others. You don't have to necessarily invest thousands of dollars in Primavera, which a lot of your big contractors are going to use, but you can use a smaller, cheaper project management software and manage your projects better. You can allocate resources, you can schedule people, you can even cut invoices on most of these software packages, and they aren't going to cost you an arm and a leg. So use that, because the faster you finish a job, the less overhead you're going to have to cover with the money from that job. Okay? People who finish jobs faster make more money. Let me say that again. People who finish jobs faster make more money. And that's what it's all about. I can't emphasize enough how important it is to run jobs from start to finish as quickly as you can get through them, while maintaining good quality standards, of course. The question is, isn't a DBE dependent on the prime to finish? You know, the prime has a schedule, and they usually bring in the DBE at the appropriate time. So when that time is appropriate, you start it. Now, they may allocate 3 weeks for your part of the project. But if you can get it done in a week and a half, you'll be happier, you'll make more money, they'll be thrilled to death because they got the same idea. So if you don't take your 3 weeks, if you only take a week and a half, that means they can move somebody else in earlier as well. They can get the project done quicker. And that's what they want to do because they're going to make more money if they can finish the job faster. Now, in terms of payment, you submit your invoice. They're going to submit that. They usually submit weekly invoices or sometimes bi-weekly invoices or semi-monthly invoices to ADOT. They want to get paid. They'll pay you. So the faster you can get it done, the better off you're going to be. even when you're dealing in a big prime structure. Yeah, you may have other subcontractors that you depend on, but they got to get their work done before I get my work done and all that. Yeah, that's part of it. But the general principle is, the faster you can get it done, the more money you're going to make. Now, we talked a lot about personal guarantees in the last workshop, in the last panel discussion. So this is all about the FICO score, right? FICO score ranges from 300 to 850. There's almost nobody on the planet that has a FICO score of 850, believe me, okay? A really good FICO score is going to be low 700s. Your minimum FICO score in order to get a loan is probably going to be 640, and some lenders may have a higher FICO score requirement than that. But 640 is kind of a tipping point there, and from that perspective. Though I was pleased to hear Phyllis say in the panel discussion that she can take a much lower score because she's assured of getting payment. There's a question about when that payment is going to come, but she's going to get paid as long as the prime contractor doesn't try to declare bankruptcy in the middle of that, all that. But other than that, she's going to get paid. So there are 5 elements that make up your FICO score, and here they are, along with their percentage influence. And so what's the number 1? Payment history. Pay your bills on time. That's the number 1 thing you can do to make sure you've got a good FICO score. That includes your credit cards, your utility bills, your mortgage, your car payment, your insurance, all of that stuff. Pay it on time. Okay, hopefully you've got those all set up as automatic payments through your bank, and so if you can set them all up as automatic payments, then you don't have to worry about that. It happens. That's what I've done. That's what makes sense. Amounts owed, so you don't want to get too highly leveraged. You don't want to have too many credit cards with high balances on them. The more money you owe, the less disposable income you have, the less you're going to be able to pay off somebody else that comes along. Length of your credit history, not a whole lot you can do to that, other than, when you're in your early 20s, you should hopefully have bought a car and put it on payment, or gotten a credit card, or started paying student loans, or whatever it is to start building a credit history. And when you have, 7, 8 years, 10 years of credit history, then that's good. New credit, so every time you create a new credit card, that puts a ding on your credit card. So you don't want to have a whole lot of new credit when you go to make that loan application. You want to have your credit long established before you get into front of the bank or other lender. And types of credit. You want to have all kinds of different loans. It's better to have, a car loan and a this loan and a that loan and a some other loan and a mortgage and a couple of credit cards rather than have 10 credit cards and everything is done on the credit cards. Okay, so you want a diversity of different kinds of credit rather than just one type of credit. Now, annual credit report, that's the place where you go to get your annual credit report. Okay, I know there are a lot of other places that advertise. This is the one that's the government-sanctioned place where you go for your free annual credit report. Okay, freecreditreport.com is not it. Annual credit report is the one you want to go to. Trust me. Now, when you go there, it's going to say, okay, here are the 3 credit bureaus, TransUnion, Equifax, and Experian. Which credit report do you want? Pick one. Just one. And then 4 months later, you can go in and do it again and pick a different one. And then 4 months after that, you can go in and do it again and pick the third one. 4 months after that, you can go in there again and do the first one. Okay, so you can monitor your annual credit report every 4 months from a different provider. That's for free. They're all for free. Now, when you get this annual credit report, it will not have your FICO score. In order to get your FICO score, that will cost you $10, probably. Okay? But you don't necessarily need your FICO score to clean up your credit. So if you look at your credit report, there may be mistakes. There very well may be mistakes. So I looked at my wife's one time. Her mother has the same name as she has, And so they had some of her mother's debt on her credit report. We were able to get that fixed. She had some of her brother's debt on her credit report. Who that happened? I don't know. So there's all kinds of mistakes they can make. People with the same name, other family members, all kinds of stuff. And you can get that cleaned up by calling them. They may have you call the lender, the account holder, to clean it up, but you can get it cleaned up. It may take a month or two before you get all that paperwork done. But once you fix one of the credit reports, the other two they'll get the word over the next couple of months. So, it takes a while, but do monitor and manage your credit reports. Okay, insurance. Workers' compensation, everybody knows what that is, right? If you have one employee, you must have workers' compensation. If you are the sole owner and the only employee of your own business, then you can opt out of workers' compensation, but the minute you hire somebody else, you must have workers' compensation insurance. 1099 workers, these are so-called contract employees, okay? Now, there is a 14-point test that determines whether they're a contract employee or a W-2 real employee, and you have to meet every single one of those 14 points or you lose. Okay, so it's very difficult to have a contract employee that will survive an audit, frankly. But, no, if you have a contract employee who really is a contract employee, you do not have to have workers' comp. But if you have a W-2 employee, even a part-timer, you have to have workers' comp. General liability. Okay, this is your slip and fall, your accidents that happen. This is kind of protects you from the general public. Professional liability, if you're an engineer, architect, surveyor, any variety of other licensed professionals, you may have errors and omissions. That's E&O, errors and omissions insurance. Vehicle liability, everybody knows what that is, and vehicle collision, of course, that's when it's your fault to fix your own car, right? So if your vehicles that the company owns, you want to have collision as well as liability, and if there's a loan against those vehicles, then the lender will probably require that you have collision as well as liability. Of course, you have to have liability in order to license the vehicle anyway. Property, fire, and theft is something you also have to have. Health care is optional, and we'll talk about that in a second. And then you may have life insurance on the key people in your organization. That life insurance beneficiary then would be the corporation, which would compensate the corporation for the loss of that individual. I don't know about you, but in my world, insurance is the #2 biggest expense that I have after my mortgage. Okay, so it's a huge thing. Healthcare and the ACA. #1 principle, it does not apply to businesses that have fewer than 50 full-time employees. Anybody here have more than 50 full-time employees? Full-time equivalent employees? No. So the ACA does not apply to businesses with less than 50 full-time equivalent employees. Now, if you have fewer than 25 full-time equivalent employees, how many in there? Fewer than 25, okay. If you choose to offer health care coverage, group coverage for your employees, you can be eligible for tax credits. You are not required to have group coverage for those employees, but you may choose to, and if you choose, you can get some tax credits. That's called a subsidy, okay? So think about that. We're going to have this optional workshop noon to 1 today. If health insurance is one of your questions, hold it for then, okay? And that's with FBC Insurance Benefits and Consulting. This is what they do. Okay, insurance brokers come in 2 primary varieties. There's independent guys, and there's guys that work for just one company. So there's the State Farm, Allstate, Farmers, all those kind of guys, and then there are the independent brokers. The independent brokers can get insurance from multiple insurers, and so they can get different bids, and you may have multiple different insurers all through one broker on different kinds of insurance for your business. So that's a choice you have. The insurance broker should look at your business and get the big picture and say, okay, you need this, 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 and this, but you don't need this and this, or whatever, however it works. So using one broker to look comprehensively at your insurance is a valuable thing. You can check on your brokers. They're called, and if you go to the Department of Insurance, which is azinsurance.gov, they call them producers. I don't know why they don't call them brokers, but they call them producers. And so you can validate their license, just like you can validate, a contractor's license at the ROC. You can also look at the insurer's ratings, the insurer's license there as well. That's the underlying insurance company that's actually going to write the policy. And then you can also look at that insurer and get a rating from them. You look at AM Best Company. They're one of the primary. There are several different people who rate insurance companies. AM Best is one of the well-known. So on my ADOT contract, for example, it says that I have to have my insurance with a company that's rated at least A by AM Best. And I imagine your contracts look the same way. So you want to make sure that the insurer meets the requirements of your customer, if that makes sense, right? Okay, bonds. So 3 main kinds of bonds. You got a license bond, so when you got your ROC license, you had to post a bond, $5,000 to $9,000 or whatever it is. Cost you $350 to probably $1,200 a year, somewhere in that neighborhood. It's usually good for, it's just good for a year, right? You have to renew it every year. Then there's the big one, the performance bond, right? This is the bond that in order to get a contract, or when you get a contract, the prime contractor is going to say, okay, we need a performance bond on you. And that performance bond guarantees that you're going to actually do the work in accordance with the plans and specs, right? That you're going to finish the job. Now, if you fail to finish the job, they're going to sue you. And when they sue you, they're going to win. And when they win, they're going to go after the bonding company to pay for the fact that they had to get somebody else to finish the job for you. And when the bond pays off on that claim, that creates a loan back on the subcontractor. So you got to pay back the bonding company principal and interest. So this is kind of a marriage between a loan and insurance is what it is. Now you can get the bond through a bonding agent, and we have Bonding Solutions LLC here. I saw they had a big line, so talk to them. They are specialists in bonding, and they will, and in fact, what he told me was that they really specialize in people that are having difficulty getting bonds. They can often find other sources that can provide bonds, even if you're having difficulties from other places. But now you can also get bonds through most of the insurance brokers, particularly the independent insurance brokers. Okay, so I know that my wife, who is also a contractor, gets her bond from General Southwest, who does all her other business insurance as well. So that works too. So many insurance brokers are also bonding agents. Now, the third type of bond is called the bid bond, and sometimes the prime contractors will require a bid bond in order to be able to participate in their bidding process. Now, a bid bond, most of the bonding companies will provide that for free or for a very small charge. And all the bid bond says is that you are bondable, and that if you get the contract, they will bond you. So it's just a letter basically saying that we've reviewed this company. If they get this contract, we will bond them, and they'll do that almost always for free. So that's what a bid bond is, separate from a performance bond. With me? Okay, so performance bond, we said earlier, marriage of insurance policy and loan. If you fail to perform, the bonding company will pay off to make somebody else perform that. And then the failed contractor has to pay back the principal and interest back to the bond company. So, what are the bond companies looking at? They're looking at your business capacity to complete the project. So, if your job is paving, and all you've paved so far is a bunch of driveways and a couple of parking lots, and suddenly you win a contract to pave 10 miles of highway, that bonding company is going to be real skeptical. Because, geez, can you pave 10 miles of highway? You know, the biggest job you've done so far has been $10,000. How are you going to do this multi-million-dollar project? Okay, so that's one of the concerns. Secondly, they're going to look at your credit rating. In case this thing turns into a loan later on, they're going to want to know about your credit rating. And they may even look at the owner's credit ratings, again, your FICO score, to see if you've got the capacity to back them up. Now, there is some help available, however, in your bonding, and that is with the SBA. They have a program that will help guarantee a portion, it's a partial guarantee again, of your bond. Okay, that can make the surety company, which is the bonding company, more comfortable in giving you that performance bond. And that information is available at on the SBA website. And again, there's an application process and on. But you can get an SBA guarantee of your bond, which could help a whole lot.